Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Jeff, and I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right, thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And don't forget it.
Welcome to the show. Thank you for joining us. If this is your first visit, please let me introduce myself. My name is Jeffrey Shank. I am the owner of Andover Advisory Group, a registered investment advisor. And we do this show on a weekly basis to share information about personal financial planning, give you some tips, keep you up to date on changes in the ever-changing landscape of personal financial services and personal financial planning. And our ultimate goal here is to raise your money IQ.
Mm-hmm.
It is March 15th, 2021, Lou. The Ides of March.
Ides
beware.
of March, yeah.
Be looking over your shoulder, right?
I am always looking over my shoulder. I'm Sicilian.
Hey, we got some good things to talk about today. First of all, 5 reasons why you might want to request an extension. I want to talk about that because a lot of people are just want to get that tax return in as soon as they possibly can so they can get their refund.
Yep.
And I got to tell you, if you're expecting a big refund, you're doing something wrong. That is to say,
True.
You're sending too much money to the federal government if you're getting a big refund each and every year. So you probably want to arrange things so that you don't have to rush to get that money back.
But don't worry, it sounds like that'll be fixed soon.
But there are some could be fixed soon. Yeah. So you heard, right?
Yep.
And so there are some strategic reasons why you'd want to file your tax return not late. I would call it just request an extension of time to file, because you can automatically before the April 15th deadline. And by the way, they're talking about potentially, similar to last year, postponing the due date. There's some pressure being put on. I don't know if that's going to happen, but there's some pressure being put on to postpone the due date.
We're debating this on March 15th?
Yeah.
4 weeks before the deadline?
I don't know that it's so much debating it, but there's some pressure being put on the federal government by certain groups that are advocating for a delay of filing. One reason is because they delayed the start time by 2 weeks.
Yes.
So they're saying, hey, look, people couldn't get this stuff together. I don't know. So, and there's some strategic reasons why you might request an extension of time to file. Mm-hmm. So the due date is April 15th, but you can automatically request through electronic filing time to an extension of time to file, which is an automatic 6-month period.
Right.
So that changes the due date from April 15th to October 15th.
There are still some levers you can pull.
Well, potentially, but those are not necessarily
the reasons.
That's not necessarily what the reasons why you would request an extension. But I've got 5 reasons why you would, and one of those reasons is not giving you more time to pay what you owe. No. So if you owe, you probably don't want to file that tax return, depending on how much you owe. But filing for an extension does not give you any more time to file your tax return.
Mhm. To pay what you owe.
To pay, I'm
Yeah,
sorry, to
yeah.
pay what you owe.
Right.
Yes, I said that wrong.
Hmm.
You're right. Thank you for the correction. So here's five reasons why, and I think I've got a slide set up, Lou.
Yes.
Okay, so 5 reasons to request an extension. The first one is 1099 corrections. You know those 1099s you get? There's 1099 INTs. There's
Yeah.
1099 DIV, stands for dividends.
Yep.
There's 1099 consolidated 1099s. And that's where you get the information on your brokerage account. And they give you all the information about the trades that you made, the short-term, long-term capital gains transactions that were in your account. This would all be for taxable accounts.
Right.
Your retirement accounts would not get such a 1099. Well, there is a series of corrections that are done. Think about it. So you're a brokerage firm, and you have all these positions in all these different people's accounts.
Right.
And each one of those positions, in some cases, represents a company that is in the midst of putting their own information together
Oh, I see. Yep.
and giving that information to the broker, and the broker is trying to get that information to you. And sometimes that information has to be corrected because they get new data.
Mhm.
They get a correction from one of those companies.
Yeah.
That says, wait a second, we screwed up. We said that you get X amount of dividends.
We didn't carry the one.
We didn't. Yeah, right, exactly. And so there are a series of corrections that are typically done by these brokerage firms. And if you file too soon, you may actually end up filing misinformation and not necessarily realizing it. Yeah, you already filed your return.
Right.
You get a corrected 1099. What do you do with that? It's past tax filing season.
Right.
It's in your mind anyway, because you've already put your return in. And so you get this corrected 1099. What do you do? Well, in some cases, it could be to your benefit. Some cases, it may not.
Right.
But if it is, well, regardless of whether it's in your favor or not in your favor, it doesn't really matter, because if there's a change, then you're going to have to correct your tax return. So if you've already filed it,
Make an amendment.
now you have to amend it. Now, if you're doing it yourself, that's your time. But if you have a professional preparer, is that professional preparer going to file your amendment for free?
No.
I don't know.
Well, probably not.
Probably not. Right.
Nor should he, by the way.
I'm sorry.
Nor should he, by the way.
Or she.
Oh, she. She's a professional.
She is.
Mhm.
And so it could end up costing you some extra money. So why, if you have a brokerage account, you have a taxable account, you might want to wait until you get through that final correction cycle before you actually push. That doesn't prevent you from putting it all together,
right,
and to begin to prepare it. But you may want to hold off filing it until you get that information. You have time to scrutinize it and make sure it's all correct before you send it in. One reason to file for an extension.
Is there any known time period when these corrections usually happen, or that basically up to the company?
Typically, they have to be done by April 5th, by the filing deadline.
Yeah.
Right. But sometimes you get a corrected 1099 beyond the filing deadline too. It happens.
Yeah.
Yeah.
Great.
And it's nobody's fault.
No.
It's just
the
way it is.
Somebody's fault.
Well, it's somebody's fault. I mean,
but you just have to deal with it.
Yeah, exactly.
Yeah.
Second reason why you might want to file an extension: distributions from partnerships, trusts, and estates. So that 1099 information that has to be sent out to the brokerage firms and then is eventually put together and then sent to you. That's for all of those publicly traded positions that you own, those securities that you own in your taxable account. Well, what if you are involved in a partnership,
mm-hmm.
a small LLC, private entity, or in some cases, there are publicly traded securities, publicly traded partnerships, where you actually get information via a K1. If that's not in your brokerage account, you hold that separately, directly with the partnership, well, then you might get a K1, which is a information about that partnership that tells you how much of the business's operating profits you have to declare on your income tax return.
Mm-hmm.
Well, they also have a time period where they have to put all their stuff together and file it. Sometimes they have to correct it. And notoriously, those K1s from those types of partnerships, they come very late.
Yeah.
And again, if there's income that you didn't put on your income tax return that should have been,
you're vulnerable.
Well, it's not so much you have to you have to eventually fix it. You have to fix it.
Yep.
So you end up filing your tax return twice. But let's say that you are the beneficiary of someone's estate. Somebody died, and you got a distribution. Well, that estate also has to tell you what portion of your inheritance is taxable in the current the current year.
Mm-hmm.
Typically, those are pass-throughs, especially if they're distributing the property to you. And so, if let's say that there was a piece of real estate that was held as part of that estate, and it was sold, potentially there could be some taxable income to you. So, again, filing that tax return before the deadline, or even by the deadline, before you actually understand what the taxable nature of those distributions of that inheritance is, could end up costing you some extra time, effort, and money.
Yeah.
The same is true with trusts. So trusts can be a pass-through entity where the trustee is responsible for adding up the income and the expenses, and then letting the beneficiaries of the trust know how much of the income that was received belongs to them and has to be put on their income tax return. Again, until you get that document, your tax return is not complete. So you could end up claiming a refund, find out 30 days later that, nope, sorry.
You had more income.
You had more income than you put on your tax return, and now you have to pay that back. And you know what? Sometimes the IRS says, hey, wait a second. We sent you that refund. You owed us that money.
Yeah.
Therefore, you didn't pay it on time. Therefore, you owe us interest.
Call us back. Yeah.
You owe us. They charge you a penalty because you claimed the refund too early.
Yeah.
Yeah. Believe it or not.
Because your notice of distribution didn't come until July.
It shouldn't.
Yeah.
But it does happen.
Yeah.
So in that case, you probably want to get on the phone and call the trustee or the executive of the estate and say, hey, should I be worried about income tax before I file my income tax return? Or should I be concerned that there could be some income that I have to put on my income tax return? All right. So here's another reason why. Let's say you're self-employed,
mm-hmm.
and you have a retirement account that's set up through your self-employment.
Right.
This doesn't work with individual retirement accounts. Doesn't even work with 401k plans unless you're self-employed, unless it's a self-employed 401k plan.
Yep.
But if you're self-employed, you have a retirement plan set up through your business, you can make a contribution to that plan up to the date you file their tax return, including any extensions.
Yeah.
So what does that mean for the self-employed individual? Let's say you had a really good year last year.
Yeah. I don't know what you were doing in 2020 and had a good year, but maybe you had a good year.
So Lou, you may be surprised at how many businesses, because of PPP, not only were able to survive, but actually did well.
Really?
Yeah.
Yeah. Good.
You You might be surprised. And so I'm not saying that that's true for all businesses, because there are some areas, some sectors of the economy that really, really got hit, but there's others that not so much, and they didn't discriminate with the PPP. They just said, "Here, we got some money for you. Please take it." Right?
Yeah.
And they made the forgiveness process so simple that all you had to do is just make sure that you use most of the money to pay payroll.
Right.
And then they said that not only do you not have to declare the forgiveness as income. So typically when a loan is forgiven, that's imputed income and you have to pay.
Right.
With the PPP, you don't have to declare the forgiven loan as income, but you can also take a tax deduction for the expense that you paid with the PPP.
Wow. Holy cow. That's like a tax credit.
This is that's like a tax credit almost. You're
Yeah.
right. Yeah.
Wow.
Yes.
That's a good deal.
Isn't it?
Yeah.
Yeah. So that was the first and second round. And third round, I don't think that it's being done just exactly the same. But they also are in the new program, and we're getting a little bit off track. But in the new program, they're making it more difficult for you to get the loan to begin with. You had to actually have seen a decline in your business.
Yeah.
For the next round of PPP.
So the self-employed retirement plan
Yeah.
contribution, you can do it up to the date you file, even if you take an extension. And if you had a good year, you can cut into that a little bit by contributing a little bit more. Cut into your taxable.
Yeah. So
Yeah.
let's say that you're a business that didn't really need the PPP, or it solved some problems for you, but you got this extra cash. Why not take advantage of it and put it into your retirement account? But let's say that you had a bad year in 2020, and 2021 is starting out better. But you still want to be able to reduce your overall income tax for 2020. By filing the extension, it gives you more time to gather up the money that you would need in order to make the contribution, because the contribution would be impacting last year's tax return. Even though you paid it on October 1st,
Right.
you could still make the contribution and have it affect your 2020 tax return. Oh, and by the way, you can actually set up one of these retirement plans today and have it impact 2020's tax return as well.
Does that have to be set up before
Another reason to file an extension, to give you enough time to get it all set up, make sure it is available to take advantage of.
So you can open it past
You can open it
before you, at any time before you file your.
before you
tax.
file a tax return.
Oh, interesting.
Another good reason to file for an extension, right?
Mhm.
Yeah. All right. I got a couple more here. Unemployment benefits.
Yes.
Under the pandemic relief of last year, there was an additional federal unemployment benefit that was tacked on top of your state unemployment benefit. It got real complicated at one point, and people didn't know how to really take advantage of it, and it did affect the self-employed. But initially, they said, well, this is going to be taxable income. Hardly anybody has taxes withheld, especially if you're unemployed, from your unemployment benefits. So a lot of people were going to get hurt by this because they had to add all that additional income as taxable income on their 2020 tax return.
Right.
The new tax bill, the new pandemic relief that was just signed into law last week has a provision that exempts the first $10,200 of taxable of unemployment benefits.
Retroactively?
Retroactive to 2020.
Yeah.
Retroactive to 2020.
Yeah.
So let's say you're one of those people that said, "Hey, I want to get that tax refund. I want to get my taxes filed," and you filed it and you put that $10,200 on your. Guess what? You overpaid.
Yeah.
Now you have to amend the tax return somehow in order to reduce your taxable income in order to reduce your tax, and you can claim that additional tax as a refund. But here's the thing: the IRS hasn't put together yet the procedures in order to adjust your tax return to eliminate the $10,200.
They're too busy working on the 2019 paper returns, so they're a little behind.
So even if you tried to file it today, you'd still not know exactly how to exempt that $10,200. And by the way, for those of you who are wondering, there is a threshold in adjusted gross income threshold of $150,000 for a couple in order to be eligible for that exemption. Okay. So if it turns out, I don't know who would be on unemployment, still make over $150,000, but if you did, then you would not be eligible. You wouldn't be eligible for that. And by the way, so it's in effect for 2020, and looks like it's in effect for 2021 as well.
Excellent.
Yeah. And what's probably the most important reason why you would file this year?
Most important?
Yeah.
I don't know.
The
Tell
most
me.
important reason? Stimulus payments.
Oh.
And by the way, they're already being deposited into taxpayers' checking accounts.
He's getting really good at this.
Unfortunately, Lou, and we talked about this, I think, last week or maybe a couple of weeks ago, when the federal government can figure out an easy way to just put money into everybody's account.
Yeah.
They just signed this. I'm sure they were gearing up because it was passed by the House, right? It was passed by both by the House and the Senate, so it was just a matter of time. So they had a couple of days before it was signed, but it was just signed last week.
They geared up for Obamacare too, and that didn't really work out as well.
Well,
and the vaccine protocols, they geared up for that too.
I mean, how many people does it take now to?
I don't know.
Probably be a new cabinet position, right? The person. I'm not sure what the name would be.
Secretary of
the Secretary of Distributions from the Treasury, right?
Yeah.
You just push a button now, and money goes into your bank account. It's kind of dangerous. Who was the presidential candidate that talked about just sending everybody $1,000 every month? Remember that?
There were a couple of proposals like that, weren't there?
Oh, there was one that was in the race for quite a while.
I forget specifically. There was so many things.
Yeah, he's from New York. He's thinking about. I forget his name, but I know that he's thinking about running for mayor of New York.
Oh,
yeah.
We'll governor's chair might be open soon.
Maybe he'll change
run for governor.
Run for governor instead.
Yeah.
Yeah. So stimulus payments. So here's the thing. There is a threshold, an income threshold, and it starts at. No, I might get confused here, but I thought it starts at 100 and it's 160.
Yeah,
right. It's 160.
Yeah.
Right, 160. And then you get a partial payment.
Yep.
Up to 170. I think it is.
170. Yeah. I think it was $10,000 on both.
So the thing is that they're looking at, since you haven't. Well, potentially you haven't filed your 2020 tax return. If you haven't filed your 2020 tax return, what they're going to do is going to take a look at your 2019 tax return. And this discussion could be moot at this point because the payments are already being deposited. But you could be that person who they couldn't deposit into your account, and they're going to figure out who to send this to. So it's possible that you might still be on the list and you haven't got your payment yet. But they're going to look at your 2019 tax return if you haven't filed your 2020 tax return. If you filed your 2020 tax return and you're above the threshold, guess what? You're not going to get a payment.
Right.
If your 2019 tax return, though, was below the threshold, then they will send you a payment. Now, the way it has happened in the last round is that if they've paid you more than what they should have based on your adjusted gross income, they're not asking you to send it back to them.
Oh, well. Yeah.
So here's the thing. What you want to do is you want to put your tax return together and figure out which year would be better for you in order to get these stimulus payments. And by the way, it's $1,400 for every person in your household. I mean, that's so much more than the last round.
The dependent age too.
Exactly. We're going to get into that in the next segment. But so what you want to do is you want to take a look, and if it turns out that your 2020 tax return is going to make you ineligible for a stimulus payment, you might want to hold off filing that tax return. You might not even have to file an extension request or under those circumstances.
Make a contribution to a self-employed retirement plan. If you're close.
Contribution to your self-employed retirement. So there, you know what? That's great.
Yeah.
That's great, Lou, because let's say you are that person who didn't get it in 2019. Okay, who didn't get a stimulus payment, this time around.
Right.
Because your 2019, you haven't filed your 2020 tax return. Your 2019 tax return showed that you were above the threshold.
Yeah, you're at 165.
180, whatever it is.
Yeah.
190, 200.
Yeah.
Doesn't really matter. Doesn't mean that you're not eligible for a payment. And the reason is because this is a tax credit. And what they're sending out is an advance on that tax credit because they want to get the money into your hands so you can start spending it sooner rather than later.
Mm-hmm.
And so if you don't get the payment because they looked at your 2019 or 2020 tax return, now that I think of it, right? Your 2020 tax return, well, it's not going to matter. I take it back. This would be a situation where someone didn't get the stimulus payment the first time around, and because their 2019, they hadn't filed their 2020. They looked at 2019. They were too. They earned too much. They were over the threshold, and now people are looking at their 2020 tax return and saying, "Hey, I could claim that credit now. I didn't get it in advance.
Yep.
I can claim that credit now, but I'm still a little bit over the threshold." If you're that self-employed individual, well, here's a good reason to hold off filing the tax return so that you can get the money that you need to make that contribution, or even set up the plan, give you enough time to set up the plan, make the contribution, and get you below that threshold if you were on the edge and be eligible for a stimulus payment.
Yep.
So these are all strategies that you need to look at because of the changes that they made and these thresholds that are in place. And you want to take a strategic look at your, not only the income and expenses and the rules, but you also want to look at what sort of strategies you should use in terms of when to file the tax return. Not just, what can I do in order to reduce my taxes, but when should I file that tax return in order to get the most out of the tax code and reduce as much as I can my income tax liability.
Can I add to consideration that if your child is a sophomore in high school, this is the tax return for your first.
That's a good point.
FAFSA.
That's a good point.
Application.
Yeah.
So you may want to where your assets are laying for that application,
right?
So that you can maximize your student aid.
That's a good point.
Yeah,
that's a very good point. Yeah. So 5 reasons to request an extension. I'm sure that there'll be more as we get further into this. And I just also want to point out that if you're a do-it-yourselfer and you want to file your own tax return, you haven't done it just yet, you can use this flow code to go online.
It's a flow code?
It's a flow code.
Okay.
Yes.
It's not a QR code anymore. It's a flow code.
This is this
flow code TM.
I believe so.
Yeah.
I believe so.
Yep.
You can use this to go online and file your taxes. Doesn't matter what your situation is. Your personal income tax return is $25. It includes federal and state. And so there's no catches. And if you have some questions about that, feel free to give us a call. We'd be glad to help you out with it. And so, as we said before, there's the new pandemic relief was signed into law last week. And so I want to bring you up to date on some of the things that we see in this, specifically as it pertains to income taxes. So we'll take a quick break. Stay with us. We'll be right back. Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005. Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio. Welcome back. Just a reminder, if you want to get in touch with me after the show, just use the toll-free number 877-475-2062, or you can send me an email. It's jeff@talkmoneyradio.com, or you can just send us a message right on Facebook. We do offer a no obligation, no cost initial consultation where we can talk about your personal situation, see what your goals are, what you're trying to accomplish, see if there's any issues that you need to get resolved. And that would be a great opportunity to take a look at your tax returns, because we talked a little bit about amending your tax return if you've made a mistake. And a lot of times that does occur, and you can amend your tax return up to 3 years after the original due date. So let's see, April 15th is coming up, 2021. So you could actually, so your first filing deadline would have been correct me if I'm wrong, Lou, 2018?
I think so, yeah.
Right, so that'd be a 2017 tax return?
Yep.
2017, 2018, 2019? No, I don't think so. Well, maybe, I think, so I think we can amend up to 18. So if you do 19, 20, 21? No, 17. Yeah, so yeah. And that's the due date plus extensions. Hey, another reason to file for an extension.
Yep.
Automatic extension of time to file. Why? Because the time to amend is also extended.
That's probably the way. This doesn't preclude you.
6 reasons. I should have put that
7,
one.
I gave you the FAFSA reason.
The FAFSA reason. That's right. Too. Yeah.
But this doesn't preclude you from filing whenever you want to file.
Does not.
So.
Does not. You're right. So once you file for the extension, you can file anytime. You don't have to wait till October 15th,
right.
In other words, to file the tax return. And we still don't know if they're going to postpone the due date, the deadline for filing this year.
I want to reline up.
Is an extreme possibility, I think.
I want to reline up the FAFSA thing too, because if your kid is a sophomore in high school, you're not thinking about FAFSA right now, but you should be, because this is the time period. Yeah. They look back 2 returns to determine your financial aid.
Correct.
Yeah.
Yep. And so, Lou, and that's not something where you get to choose, or depending on which one you filed, that's the one they're going to use. They have a hard and fast rule. We look back 2 years. And
there are some important distinctions about how your assets for, student for tuition savings plans, whether it's in your child's name, whether it's in your name, there's important positioning considerations.
There is, but that doesn't necessarily affect your tax return. I want to be clear that there's only a few things that you can do to affect your tax return after the year closes. One of those is the retirement contributions. However, voluntary contributions to retirement plans don't really help you in the financial aid formula.
Okay.
Unfortunately,
Mhm.
they don't. And that's because they add that back into the income calculation. So they take your AGI and they say, how much did you put into your 401k voluntarily? How much did you put into a self-employed retirement plan? And they add that back in. But it could potentially reduce your AGI for purposes of claiming the tax credit, the education tax credit,
Yep.
if you have kids in college in the current year. So
It's time to start planning, though.
yeah.
Yeah.
It's a big part of your overall plan. And guess what? They've just made it more complicated because of the pandemic relief, because they changed. Not only did they give out some payments, some advance credits as stimulus payments, which, by the way, $1,400 per person. And for there's a threshold, $150,000 up to 160. You go to 160, you don't qualify at all.
Mm-hmm.
But they've also made the same amount available for dependents, and they've decreased or increased the age at which those dependents would be eligible for a payment. And so that is just for the current year. That's just a one-time thing, unless they redo it. But they've made some other changes to the tax code that are more long-lasting. There is, and we just wanted to highlight some of these things. So there is and this is just a one-time thing for 2021. There's a new COBRA continuation coverage premium assistance program. It's going to be in effect between April 1st and September 30th. So that if you lose your job and you are covered by COBRA, the federal government is going to help subsidize that cost. COBRA is just let everybody know, COBRA is a program where if you lose your job, you lose your health insurance, you start to pay for it yourself under COBRA. It guarantees that you can have that coverage, that group insurance coverage, at the group rate for a period of months.
Yep.
Right. And so the federal government, through the tax code, is going to give you a premium tax credit, essentially, to help subsidize that. And they can give you an advance payment on that. And that's in effect between April 1st and September 30th. There's also an expansion of the child tax credit. And this, the act makes the credit fully refundable for 2021 and makes 17-year-olds eligible as qualifying children, whereas before they were not. And it increases the amount of the credit to $3,000 per child, $3,600 for children under age 6. Again, there's a threshold. $150,000 is that threshold. I guess that's the new wealthy taxpayer.
Yeah, really?
$150 for a couple.
From legislators who don't live in the Northeast, apparently.
And so they actually, this new tax credit, right?
Mm-hmm.
The IRS is, remember I said that there was that entrepreneur who was talking about a $1,000 a month payment to everybody from the federal government. So this new tax credit is fully refundable, but it's also available as an advance. So the federal government will send you your tax credit every month as an advance.
Wow.
And that's from July through December 2021.
Federal government's just awash in cash, apparently.
Apparently so.
Yeah.
Yeah. There will be a portal set up. I don't know how they're going to do this in time, but there's going to be a portal set up if you want to claim your tax credit in advance and get a monthly payment on that tax credit. You will have to reconcile that advance payment at the end of the year. So if you're not eligible for it, you may have to give some of it back. But there is a threshold by which, if your income is below a certain level, you won't have to pay it back.
I see.
So why wouldn't you, as a taxpayer, get that advanced tax credit, especially if you might not have to pay it back? So they've also made some changes to the earned income tax credit. The minimum age to get the earned income tax credit. Now, the earned income tax credit is a tax credit that was originally designed to transfer. It's really to transfer money from the federal government to certain individuals below a certain income level who had children.
Yeah,
essentially. Now they're expanding this earned income tax credit. And by the way, last time I looked at the numbers on this, the earned income tax credit, it was about $50 billion of hit to the budget.
Nothing. Loose change.
Yeah. Well.
Yeah.
50 billion here, 50 billion there. Before you know it, you're talking about real money, right?
It's only 10 walls.
That's only 10 walls.
Yeah.
I say that's the last time I looked at it, but that was years ago. That was probably, I would say 5 years ago.
Oh, yeah.
It was the last time I looked at it. And so it's probably more today, but they're expanding it even more. So they are going to expand the earned income tax credit. And it introduces special rules for individuals with no children. We're not going to get into the details. I just want to point this out. And why would you need to know this? You need to know this because if you're doing any sort of planning, remember I talked earlier about getting a big refund?
Yeah.
So if rather than get a big refund at the end of the year, why not adjust your withholdings such that at the end of the year, when you file your tax return, you don't owe any money, and you don't get a big refund. You sent just the right amount of money to the government in advance,
and you've had more money over the course of the year.
More money in your pocket to pay your bills and to do the things that you want to do.
But
right?
people don't think like that. They like the check that they get at the tax refund.
And
when
they don't
Christmas
get it,
savings plan.
right? And when they don't get it, they think that something was done wrong. Right? Yeah. So why I'm pointing this out is because these new credits are going to potentially reduce your overall income tax. Well, you want to plan for it.
Yep. And
you want to make sure that whatever estimated taxes that you're making or any withholding is going to be consistent with your personal situation at the end of the year. And so for 2021, the minimum age is decreased to 19, except for students, 24, and qualified former foster youth, age 18. The maximum age is also eliminated. So the credits phase out percentage changes. The credit will be allowed for certain separated spouses. So in the past, if you were filing separately or you were living separately, you wouldn't necessarily be eligible because you'd have to look at your spouse's income.
To one or the other gets the credit.
No.
Oh.
No, it probably wouldn't be available at all because your total income, the total marital income between both spouses was too great. But now an individual who has low income could actually qualify potentially for the credit. This is for 2021. And taxpayers will be allowed to use their 2019 income instead of their 2021 income in figuring the credit amount. How's that? The earned income tax credit for 2021 to claim it for 2021. You don't necessarily have to look at your 2021 tax. You can go back to 2019 and look at how's that? How's that going to work?
Going to keep the IRS busy.
And tax preparers and advisors and financial advisors. Really? Earned income tax credit? 2019 tax? That's what it says here.
Yeah.
I'm assuming this is accurate because I get it right from an article that I read that was written by accountants, CPAs.
So as you're filing your taxes for 2020, as you know the numbers, you don't have to use the numbers. You can use the 2019 numbers.
No. So this is for 2021. So these are changes that are not in effect for 2020.
Oh, okay.
But are being changed for 2021, and that includes the increase in the child tax credit. Right. That's all for 2021.
Oh, I see.
It could be temporary. Some of these things have been made permanent. I think they increased it for 2021 and beyond, but it's higher in 2021 than it will be in the future. That's the way it looks. And the earned income tax credit, that's a 2021 change, not a 2020 change. So this is not, you're not going to be eligible for the earned income credit in 2020 based on these new tax rules. Let's see. And this is important too. The threshold for disqualifying investment income is raised from $2,200 to $10,000 for the earned income tax credit. So again, this is the earned income tax credit. You make below a certain amount of income, but you still have earned income, and the government is going to send you a tax credit. It's fully refundable. And for some people, let's say that you were a widow.
Mm-hmm.
You were relying on, you didn't have your own employment, or you had a small job, and your spouse died, left you with some life insurance that now you've invested. Well, if you earn more than $2,200, you get this a small job, and you've got the investment income. You're not eligible for the earned income credit because that investment income was more than $2,200. They're raising that to $10,000.
Yeah, well,
that's important.
Yeah.
Now, why is that important? Well, because now you can earn more, you can invest it and earn more, and still not disqualify yourself for the earned income credit, and it gives you more opportunities to do some planning. Let's see. So let's see. They changed the dependent care assistance threshold for 2021 up to $10,500. Now that's really important. Now, I don't know how people are going to deal with this, and it's something that I'm going to get into, and maybe we can talk about it on a later show. But the threshold was under $6,000, where a company could set up a plan that would reimburse you for your dependent care. You put the money in tax, pre-tax, and you take it out to pay for dependent care expenses without tax.
Dependent care expenses are?
Daycare.
Okay.
I'm sorry. Daycare expenses.
Okay.
Should have called it.
Yep.
That. Yeah. So normally what happens is you decide in November of the previous year how much you're going to put in the following year. So you've already made your decision in November of 2020 how much you're going to put into your dependent care assistance program to pay for dependent care expenses in 2021. Well, they raised it for 2021. So that means that if you have that kind of a plan, then you're going to, and you didn't take full advantage of it, then the company is going to have to give you a window of opportunity or an opportunity, not necessarily a window, but an opportunity to top off that account to give you more money on a pre-tax basis.
And the raise was 6,000 to 10,000.
I thought it was 5,500.
Okay, yeah,
it was 5,500. I could be wrong, but right around there. So I went to 10,500. Yeah, and so that's how those programs work. Employer provided dependent care. It's all a pre-tax contribution out of your paycheck. So somehow the companies are going to have to make some changes to their program and allow people to put more money into that before the end of the year, so they can take full advantage of that new threshold. Yeah, there's a bunch of other stuff in here. Some of it's short term, some of it's longer term.
Yeah,
we don't have time to go over all of it, and this is just the tax portion. This is not even talking about the unemployment benefits. But by the way, that $10,200 exemption for unemployment benefits, exempted from income tax for people who are under $150,000, that's in effect for retroactive to 2020. So if you filed your tax return already and you included that $10,200, you can now reduce your taxes. But it's also in effect for 2021. So the new unemployment benefits that are coming will be exempted also. And I believe I'm gonna have to verify this. I think it had everything to do with the federal benefit, but it may be state benefits also, and I'll clarify that on a future show as well.
It's quite a menu. This bill is quite a menu of things.
Yeah, and now, as you said earlier, Lou, there's talk about reforming the tax code and
the bill's going to come due at some point.
Raising taxes.
Yeah.
They just went through all of this to reduce taxes, and now they're going to reform it, and they're talking about raising tax. I'm not sure how they're going to do that, or if in this this current configuration of Congress, whether or not they could actually get anything passed that would actually increase overall income taxes. We'll have to.
Well, they'll pick out a certain threshold and target that, and that's usually popular.
Right.
Yeah.
Right. You mean higher income individuals?
Yeah.
Is what you're saying?
Yeah.
Yeah. But what we can tell with this new legislation is that it was designed and targeted lower income individuals, because that's where the bulk of the changes in the taxes and the tax credits and the exemptions.
This is where some tax preparing help comes into play for people who don't normally get it, because
that's a good point.
A lot of these things are targeted for people who don't normally do complex tax returns, but they kind of have to take advantage of most of these situations.
Well, at least they need to know how it works, and what qualifies, what doesn't, and whether or not they're doing it right. You're absolutely right. So for people who would normally just, use one of those desktop forms or go online and do that, and all they had was a W-2. There's all kinds of things here to consider, and you're right. There might be some people out there that would normally have a pretty simple tax return that all of a sudden has become very complex.
Reason number 8 to delay, because those online situations aren't going to have their act together by April 15th either.
Yeah, I don't know.
On all this stuff.
I don't know. I'm anxious to see how quickly they can get this unemployment compensation thing figured out. And it's typically unusual. It's unusual that a new law would affect the current or previous years.
Yeah.
Usually they want to give people time to figure things out, give the software, the tax software companies time to get their act together, right? Give the IRS time to get their act together. But in this case, there was a rush. There was a rush to get this in place and to affect this year's tax filing. Yeah, really. And then a lot of the changes are going to affect the 2021 tax year. And I'm certain, as it always happens, there's going to be some unintended consequences here.
You think?
Some things that we're going to be looking at and saying, "Wow, really? Yeah, that's the way it works? Seriously?" A lot of times there's interpretation. So this is the law. Now the IRS has to put the rules together. Yeah, and communicate that. Right. And they'll probably make some mistakes, as they have in the past, in terms of
take care of these all odd interpretations of qualification and things like this. It's going to increase fraud, as most benefit programs usually do. Yeah. We've seen it in Massachusetts in the unemployment program. We've seen it in tax, in the IRS in the past. Well, the earned income tax credit was a great example of that, wasn't it?
Yeah. So actually, electronic filing was opened up a whole host of fraud, because people were able to get someone's tax ID number, the Social Security number, and file a fraudulent return in mass. Mm-hmm. File 100 returns in seconds. Yep. And just claim a refund based on some bogus numbers. That's how it all started. Yeah. People would just file a tax return. The numbers didn't have to be accurate. They just said, "Hey, you owe us some money," and the IRS would look at the tax return and say, "Yes, they have more money here than what they said they owed, so we are going to send them a check." And it didn't matter that they were sending the same. They were sending all those refunds to the same PO box in the Ukraine.
Yeah, in the Ukraine. I didn't know they were going out of country.
Yes.
Oh, I didn't know that. Yeah.
Yes. They were going. Yeah, they were going out of the country.
Wow.
To accounts, but it was just a computer. It was looking at an account number and transferring the money, so it was all electronic. It happened to a client. It happened to a client of ours, and as it turns out, the tax year in question, that person was deceased.
Well, probably voted too.
So here's the thing. Here's that probably voted.
Yeah.
So here's the thing. What happened was, and this was just a perfect example of what I was talking about. They filed this fraudulent tax return trying to claim a refund. Well, the person had no income that particular year because they were dead.
Yeah.
And so
that'll suppress your income.
And so the IRS sent a bill.
Did they?
Hey, we got your tax return. You owe us $5,000. You said that we owed you $5,000. As it turns out, you owe us $5,000.
Luckily, I'm dead. So
it took us a while to get it straightened out. But this goes back, I'm going to say 10 years. And I'll remember this distinctly.
How long did it take you to straighten out that the guy was deceased?
Well, it didn't take us long well, initially we looked at it and said, oh, wow, they owe $5,000. Who screwed up? And then and then it occurred to me, wait a second, that tax year?
Yeah,
that person wasn't here. So we ended up calling, helping the client. We got the IRS on the phone, and they said, okay. Well, here's what's going to happen. He said, you're gonna get a series of collection letters. Nothing we can do about it. Just ignore them.
Yeah, it's in process.
No, not even in process.
Yeah.
Just ignore them. We'll eventually write it off.
Oh, I see.
That's he didn't say that. He didn't use those words. But eventually they'll stop coming. I said, okay, well, what information do you need so that you can follow up on this and find the perpetrator?
Don't worry about it.
No, we don't need that.
Yeah.
Don't bother. That was when it was a huge problem.
Yeah.
And I said, well, that's the reason why, because they don't care. They're just waiting for you to call up and say, hey. That right after that, it was shortly after that they started the PIN program, and they started warning people, and they started putting systems in place to make it more difficult for these fraudsters to file these returns all at once. So they finally got their act together.
So to an extent.
To an extent.
Yeah.
Yeah. Well, it's a lot better than it was. Let's put it that way.
Yep.
All right. So that's the end of our time today.
So look into filing an extension.
Yeah, well, take a look, see if it makes sense to file an extension. There's hundreds of reasons why you might want to file an extension.
And it doesn't preclude you from filing your tax returns when you want to. So there's really no reason not to do it.
This is true. Yeah. And so, we just touched on some of the changes to the tax code for 2021. So check back in. We'll follow up on this. We'll have some more next week as well. And we'll probably find out some stuff.
Yeah.
I'm sure there's going to be some surprises here as they start to implement this program.
Now that they've passed the bill, we can find out what's in it.
So you definitely want to come back next week and the week after and we'll share with you the things that we find out. So, hey, thanks for tuning in. We'll be back next week, same time here on Talk Money. Remember, in the meantime, good advice is much better than advice that just sounds good. Thanks, Lou.